So good afternoon, everyone, and thank you for attending today's webinar. My name is Claire Barton, and I will be your host. This webinar is brought to you by the Chartered Governance Institute of Canada, the only global qualifying organization in Canada where you can become a chartered governance professional. For further information about our programs, memberships, and upcoming seminars, I invite you to visit our website at www.cgiofcanada.ca. Today's webinar is entitled Trends in Executive Compensation and Governance. What should boards be asking? And our guest speakers are Amanda Voegeli and Ryan Resch. Amanda is founder and managing partner of Southlea Group, a compensation consulting company in Toronto, Ontario. Amanda has a Bachelor of Commerce from the University of British Columbia and holds a Chartered Financial Analyst designation. She's a trusted advisor to many of Canada's largest and mid-sized companies, both publicly traded and private. Amanda frequently presents on topics of compensation and governance matters. Ryan Resch, founder and senior partner of Southlea Group. Ryan has a Master's of Business Administration in Management and Organizational Studies from Simon Fraser University, as well as an ICD Director's designation. He has many years of experience consulting with organizations across North America regarding executive and broad-based compensation, including governance-related considerations. Before we begin today's presentation, I would just like to mention that everyone has been muted, but should you have any questions, please feel free to click on the chat button at the bottom of your screen. And with that being said, I will now turn things over to Amanda and Ryan.
Thanks so much, Claire. I really appreciate it. So please, I'm very pleased to be here today and partnering with you all. As you mentioned already, Claire, we're trying to make this a little bit interactive and fun. It is a presentation format, but please don't hesitate to stick those questions in the chat as we go through each topic. We actually have placed our own questions of one another on certain topics. These are the most commonly asked questions of ourselves that we thought we would sort of help that conversation along. But if that spurs questions from you all, please feel free to jump in via the chat feature of your Zoom. So if we kick it off here on this page, just to set the context, when we refer to executive compensation and governance, the list on the screen represents the most common areas of focus for the boards and the human resources committees in particular. We can kind of group them into three categories. We talk a lot about pay levels, pay design, and pay oversight. And I won't read what's written in the columns there, but we share this list of topics as context, and we note that this list reflects a point in time, currently, what we see happening at the boards and in the human resources committees. And we acknowledge that because the mandates of the Human Resources Committee in particular, based on our experience, is continuing to evolve. For example, we see increased focus on social topics like ESG strategy, CEO and senior executive succession planning, diversity and inclusion, as well as the broader workforce, human capital topics, including things like culture, turnover, and engagement. So with that, we'll dive into the slides that we've prepared for you today.
So I'm going to kick it off with a couple of slides on pay levels. And so first of all, just as we start to anchor the discussion around pay levels, this is really about sort of how much do we pay executives with the goal to, support the attraction, retention, and motivation of talent needed to deliver upon the organization's strategy. And so we talk a lot about setting target pay. And so where do we want to target the pay structure overall for expected performance, typically at the 50th percentile or the median of the market, and then allow for pay to go above or below target based off of performance, either individual performance or company performance. And so the philosophy and agreeing upon, who are the underlying peer companies, what is the mix of pay that we intend to offer, are sort of foundational decision points that boards need to wrestle with as they start to think about how best to calibrate their pay relative to market. We include here a few different considerations around executive pay. And so thinking about the idea of, are we paying for in terms of the current size and scope of the organization, or if we're in a fast growing business, do we need to look future in terms of a little bit more aspirational in terms of setting pay, not for the organization that we have now, but the organization that we're going to soon become, and reflective of the type of talent that we will need to deliver upon that growth. There's a lot of discussion also around the internal alignment. So not only do we align pay externally to market, but what is fair and equitable amongst the executive team? What is fair and equitable as you look more vertically within the organization? And then also what's fair in terms of the overall link between not only the salary, but the total rewards opportunity provided to executives. And so for some context here on the right-hand side, we summarize, this is total direct compensation for CEOs and CFOs within the TSX 60. So this does represent 60 of the largest Canadian companies. And you'll see there that CEO pay, CFO pay went up by about 20% year over year in 2021 over 2020. And so basically the bars, as you see there, the bottom of the bar represents the 25th percentile of the market, the top represents the 75th percentile of the market, and where the color changes, that represents the 50th percentile or the median of the market. And so you can see there that pay did go up significantly year over year. But as we looked into it, the primary driver of that change was really the change in actual bonuses on a year over year basis. So actual bonuses paid, so for 2021 performance versus 2020 performance, which was the start of the pandemic. So you can imagine that 2020 bonuses were somewhat more constrained, whereas 2021 was a much stronger performance year. And so therefore bonuses were up significantly, which contributed to the increases that you see here. If we look at the underlying salaries were only up by 2 to 3%, and long-term incentives were essentially flat over the period. So it'll be interesting to see as we look forward in terms of, given 2022, some more of the challenging market conditions, as we think about inflation, as we think about some of the supply chain challenges, the total shareholder return and share price challenges. It'll be interesting to see where does pay go going forward. So as then we look back for 2022, do we anticipate that it will be somewhat more muted on a year-over-year basis looking forward? So maybe I'll just sort of pause and just in terms of Amanda, as we sort of look at this, and we talk a lot about setting target pay sort of aligned with the 50th percentile, but where do we see different philosophies, I guess, being applied?
Sure. Yeah, I'd say the vast majority of companies, as we've said a couple of times now, try to develop the appropriate peer groups such that the middle of the peer group looks like your own organization in terms of industry size, complexity. And then when you've done that hard work around defining the market for talent and aligning it with those principles and factors, targeting the 50th percentile makes very good sense because you've already adjusted for those other factors that you should consider when you're determining pay. A couple of examples I'd share with you that there are actually different ones. For those of you that have been across many boards and have only ever stayed a 50th percentile philosophy, you do kind of wonder sometimes. So we are seeing a lot of technology companies taking an innovative or different approach to setting their compensation philosophies. And in quite a few of these, in particular pre-IPO private companies, we're finding that they're choosing to be quite a bit more aggressive with their pay philosophies. And interestingly, many of them do not have short-term incentive plans. There's a philosophy behind a number of entrepreneurial CEOs that own the companies that having a short-term incentive plan actually can distract from aligning with the long-term interests of an organization. You might understand that coming from a high growth, heavy investment organization that you might have to see beyond 1 year. And they also, because of the nature of technology market, and maybe in particular in Canada, the talent is scarce. They are also targeting these salaries at a competitive total cash level, because so you just ignore the bonus part and you target the salary as though it's including a competitive bonus. So it does change the dynamics of how you think about pay. And in quite a few of them, again, because of scarcity of talent, they are targeting the equity portion of the package or the long-term incentive at the 75th percentile of their appropriate peers, again, to try and differentiate the employment package for the key individuals that they're trying to recruit. So that's an example of quite a different one. And on another extreme end of the spectrum, I'd suggest we talk about a not-for-profit as an example, where you might still see them targeting the median so that they're having a responsible, fair, and equitable approach to pay, but they also are a bit restricted and often don't have bonuses. And in order to make up for some of this lack of incentive, they do have higher benefits or pension values. So you can see there a few different examples of how we see different organizations reflecting what they have available to them and to reflect their compensation philosophies.
Perfect. That's great. Thanks, Amanda. So we'll move on and talk a little bit about board of director compensation as well. And, boards typically go through a fairly similar process, as you would for setting executive pay in terms of identifying an overall philosophy in terms of our pay philosophy for board members, who are the right peer companies that we would compare against in terms of the types of directors that we need to recruit into our organization. In many cases, that pay philosophy may align very directly with executives. In other cases, it may differ. But generally speaking, this is sort of the philosophy of the approach is very similar. But then the mix of pay or how compensation is delivered is quite different. And so obviously board members play a different role in the organization. And so their pay generally is formed of a mix of a retainer, cash, and in public companies, you would also get an equity or a share-based retainer, the use of meeting fees, additional fees for being members of different committees or acting as certain chairs of committees and or other leadership roles. So there's sort of a whole mix of different elements that get combined to form total compensation. And so you can see here on the right-hand side, this is reflective of the S&P TSX composite. So it's not just the 60 largest companies in Canada. This represents about 240 companies that form the composite index. And you can see that there's a fairly broad range of pay. So for the total sample, it sort of ranges somewhere between $125,000 to $210,000 in terms of total board member compensation on an annual basis. But as you can see there, we've broken it up into sort of three different size categories. And there's a clear relationship between the size of company and the pay that is offered for directors in those companies. Obviously, the size and scope and complexity of the organizations change as you become larger. But it is interesting that there is a fairly wide range of pay, which I think also sort of demonstrates that there are a lot of differences depending on industry and the type of director talent or the type of skill sets that are required within different industries. A couple of different issues that we see, you'll have noted on the left, this concept of fee simplification is becoming increasingly common. So the use of meeting fees, when we look at the TSX composite, less than, I believe, 1 in 4 companies currently provide for meeting fees. And so what they've done in many cases is that they've incorporated an equivalent number of expected meetings within the annual retainer, with sort of the recognition that a lot of work happens not just meeting to meeting, but throughout the year. And so it makes more sense that we just pay an overall retainer and move away from the use of separate meeting fees. We're also seeing stronger share ownership requirements and also differences in how to deliver equity compensation. So in a public company, the form of equity compensation that the vast majority of public companies provide directors in Canada is called a deferred share unit. And the deferred share unit is somewhat tax advantageous because You don't pay tax until you redeem the DSUs, and you can't redeem the DSUs until you leave the board. But what that does, that limited sort of liquidity can create some challenges, because if you've been on the board for a long period of time, you can accumulate a fair number of DSUs that you can't redeem until you leave the board. So there's lots of questions around how best can we deliver equity compensation in a way that allows them to maintain share ownership, but also have increased flexibility. And I'm just going to pause there, and I believe we have a question from Rachel, if Rachel wants to ask her question.
Hi, good day. Yes. My question is, these figures, I'm assuming they're annual, or is it monthly? What's the basis of the total board?
No, that's
Okay.
a great question. Thanks, Rachel. And so this is representative of annual compensation in total for the year would range somewhere between 125,000 to 210,000 in terms of annual compensation.
And I guess it does not include executive directors. So this is what people who are just strictly for your work on the board.
Right. These are the non-executive directors, and this also excludes any additional compensation that would be provided to either a board chair, or if you're a chair of the audit committee or one of the committees, this wouldn't include that additional compensation.
Sure. Okay, thank you. Just wanted clarification.
Yeah, perfect. Thank you.
Maybe I'll probe a little bit with you, Ryan, in terms of some of the common questions that we get, as I was mentioning. So two of the main ones are around this question of, do we have meeting fees or do we not have meeting fees? Maybe you could spend a minute talking about the thought process that organizations go through to make that determination of in or out.
Yeah, I mean, it's an interesting question, and I think it's one where on one hand, you're looking for simplification instead of the sometimes you get into a bit of a debate, especially if you're in a sensitive situation and there's a number of meetings occurring. At what point do you define an official meeting for the purposes of being paid a meeting fee versus is this not a formal meeting? And so sometimes there's some debate as to when and if meetings occur. The other one is around differences in workload. And so, if depending on which committees you sit on, some boards have it fairly equal or equitable amongst the board members, where everyone's on two committees and the workload is fairly well spread out. In other cases, that's not necessarily the circumstance, where you've got certain directors who take on more of the burden than others in terms of their committee responsibilities. So sometimes you get some debate over whether or not you need to have meeting fees in order to provide for that differentiation. But for the most part, I think boards are sort of realizing that those sort of relatively small differences in the end aren't worth the complexity of having meeting fees. So it's much easier to say, if you are a board member, you are contributing overall. It's not necessarily simply because of what committees you're on. It's not necessarily simply based off of the number of meetings you're attending, but your contributions overall. And in those cases, that's where we're seeing, close to probably 75% of companies now have moved away from meeting fees and have moved to just simply providing that all-in retainer.
Mm-hmm. An interesting tidbit also is that this all-in-one retainer situation has existed in the US quite a bit longer than it has in Canada, and seems to also be a bit of a trend that's coming.
Said I should come back for it.
Also, I think people are interested in differentiation across committees, because there's a perception sometimes that not all committees are equal in terms of workload and responsibility as it might be articulated. Is there a difference in pay? We get asked a lot.
Yeah, and there are differences, particularly for committee chairs. And so when we look at audit committee chairs, typically get paid the most. There's usually a multiple over the sort of the lowest paid committee chair. And then increasingly, we're seeing the compensation in HR committee chairs are also receiving higher compensation relative to the lowest, but not quite as high as the audit committee yet. But that might change over time, I think, as there's more pressure, more responsibility being put on the HR committee. You're starting to see that reflected in compensation. You're also starting to see it depending on the types of companies within the nominating governance committee, particularly if that committee is taking on more responsibility for some of the ESG related mandates. So you're starting to see a bit of a shift there. But that's where you will tend to see differentiation, particularly for those committee chairs. And it'll be interesting, I think, what boards are wrestling with as well right now is just in terms of ESG, who is responsible for it?
Right.
Does it sit within one committee? Does it sit amongst multiple committees? What additional workload does that, require of each of the committees? And therefore, do we need to sort of continue to differentiate fees accordingly? So we'll sort of see how that plays out over
Yeah,
time.
it's going to evolve for sure. Okay, on this slide, in terms of market trends, we're talking about short-term incentive plan designs. And what we would say is that there has been a slow evolution to the designs that represent more of a scorecard approach as being quite a dominant plan design these days. And so it would have key metrics, including both financial and non-financial measures. It would have some quantitative aspects and some qualitative aspects to how performance is being measured. And given we're talking in this slide about the assessment and payment of rewards for a one-year performance period, it's important that the organization take a step back to see what is needed or expected to be accomplished within that 1 year, as opposed to the midterm or long-term incentives. So generally there's reflection on what public companies have told their shareholders in terms of guidance, or what are the key metrics that analysts are reviewing to understand where the organization is going and where the risks might lie. And also we find, back to the idea of a balanced scorecard would also lead you to looking at not only financial indicators, but operating measures, employee measures, and customer measures. So there is quite interesting conversation going on as it relates to ESG in particular, the environment, the social, and the governance aspects of the business. There's lots of reporting going on about what the organization is doing. And there's a lot of questions being asked about how and if compensation is being tied to those important measures. And so many boards, I'd say all of the boards we work with are grappling with this, as well as the management teams, frankly, to decide at what point it's important to be in the pay scheme and then measuring that. So once you pick your measures, of course, there's a whole calibration exercise of what am I willing, at what performance level do I expect performance to be at in order to pay a target incentive versus a 2x incentive. So there's quite a bit of obviously nuanced work that goes into back testing and forward testing measures, and as well as the ones that are softer. You still need to give yourself some guidelines around what is maximum performance on something that is actually more qualitative in nature. We're seeing an increased attention to diversity metrics in the short-term incentive plan, as an example, in terms of proportion of workforce that are meeting your diverse quotas or objectives or goals, or by level, accomplishing sort of pipelines of the right gender or background heritage that you're looking for enhancing within your organization, as an example. Individual performance is also included. We've got on the slide there. It's true, there's quite a debate when you get to the CEO level in terms of sometimes the perspective is that all of the goals are the CEO's goals, and you don't need to have an additional weighted component towards a list of additional objectives. But generally, we do see most organizations in Canada having a portion for each executive's specific domain, in addition to these more corporate scorecard measures. The payouts all have maximums, either generally between 1.5 to 2 times target. And the last bullet on the page there is talking about, we use the word informed judgment. It's often more accepted by board members and shareholders than the word discretion. And what we're meaning by saying informed judgment is considering ahead of time the framework that you might use to apply judgment or discretion, thinking about the factors outside of management's control, perhaps, factors that would impact these performance metrics that are clearly articulated within the plan, if you want to have a list of factors or an understanding of adjustments to your financial metrics or anything of that nature to help you at the end of the year, so it doesn't feel like it's being, made up or being, pulled out of thin air. We did a lot of work post 2020 and due to COVID, where discretion was having to be applied when the programs didn't work, in order to help them be better prepared and to make their programs a bit more resilient to these shocks that can happen throughout time. So just on the right-hand side to help you understand what you're seeing there, it does, this chart summarizes the prevalence and the average weighting for each of the metrics displayed. And again, the sample is the S&P TSX 60 companies. So you'll see it's quite dominated by financial metrics such as profit, representing about 50% of the weight, followed by a mix of other financial measures such as cash flow, revenue, expense management, which are lower weights in the sort of 20 to 30% range, as an example.
So in terms of, you talked a little bit, Amanda, around COVID and the increased use of discretion. What else did we, I guess, learn from COVID in terms of incentive design, given that in many cases the plans may not have worked as intended?
The first and foremost is that use of discretion and judgment, and having the ability to do that in a more framework type way. The other one would probably be about diversification of measures. And so there has been a move for those organizations that had one primary financial metric, a bit of a move towards perhaps there are two measures that are good indicators of performance, and they don't move in the exact same way, so that you are at least giving credit for the other measure that might be equally as important but not captured in the program. And the third thing I think would be, again, the target setting and taking a step back. A lot of organizations had just gone through the motions of every year we use revenue, every year we use 80/120 as our threshold and our maximum, parameters. And nowadays there's much more consideration of back testing it. If we had had a wider range, what would our payouts have been? And does that make more sense or less sense than what we have today, as an example? And I think that it's really this additional of the ESG measures, and how do we tell our story about that?
Right. Yeah, no, I'd agree. And the whole target setting, it's one where I was on a call yesterday, and they used 80/120 for every single measure, and they've done that for the longest time. And you sort of go, why did you go 80/120? And they're like, well, everyone else does. So it's an interesting one to sort of think through in terms of what is the right performance range and how do we do calibrate it appropriately.
And they don't even have to be balanced, I think, is the other one. Is there downside protection? Are we being more gentle on the downside and harder on the upside, meaning it should be harder to get the 2x than, and easier to pay something, is sort of a more gentle performance and payout curve. We're sort of seeing some interest in. So on this slide, the next topic, of course, is long-term incentive vehicles. And on the screen, we outline here the three main vehicles used in Canada, similar to US, but with some nuances just due to different tax and equity sort of rules. So maybe I spend a minute just going quickly through what you're looking at here. So a restricted share unit on the left-hand side of this chart is used to track the value of one unit. One unit would be equivalent to, if you're a publicly traded company, one share, and it would go up and down with your share price over time, and would attract dividend equivalents if you had dividends over the performance period. The performance period is generally 3 years. In Canada, it can be longer, but we'll talk about that in a minute. And at vesting, the units would be settled in cash or in equity, and the participant would pay income tax on the value that they received. Again, an asterisk there in terms of how much tax. The primary purpose of this vehicle is to align executives with investors, obviously, and to retain them for a period of time, because as you can see, the performance indicator is really share price and dividend over a 3-year period, nothing more than that. So that's a restricted share unit. The performance share unit is similar to a restricted share unit in terms of tracking the value of the share price over time. But what's different is the vesting. So at the end of the 3-year performance period, some type of assessment is made against a financial or a market indicator of success or performance. And the number of units that vest is adjusted either down or up based on the successful completion of those performance indicators. So you can see that there's much more risk and there's much more reward in a vehicle like a performance share unit. You have to do a lot of work to get the performance measure right, and you also have to do that calibration of performance we talked about with the short-term plan within the long-term plan. Very common vehicle for sure in Canada. And finally, we'll mention options. So we refer to options as appreciation plans because, as you'll recall, you only receive the increased value of the share over the period of time as compared to the other two plans. I mentioned you would get the full value of the share. If the share was worth $10 when it was granted and $10 when it vested, you get the $10. In an option plan, if you're granted at $10 and it goes to $15, you get the $5 appreciation gain is what it's worth to the participant. So they're different in that they are able to and are commonly longer in time horizon. They're generally 5, 7, or 10 years in period of performance. And they often can vest even over beyond 3 years. They can vest over 4 years or 50% at 3 years and 50% at 4 years. So generally stock options do have that longer time horizon. And many of you probably know about the recent tax change on stock options in Canada, which is fairly new, and I won't dwell on it. But because this change in stock options, which essentially historically stock options in Canada had a capital gains like treatment for the gain, so you'd only pay 50% of the tax on the gain at the time of exercise. So you're deferring tax for longer and you're paying less tax on it. That has changed, and now there are sort of limits on how much a participant might get, up to about $200,000. It's very complicated. We don't need to get into the math on that. And it's actually up to the company to decide if it's qualified for that tax treatment or not qualified for that tax treatment, because only one party gets the deduction. The company can keep it, or an employee can get the benefit. So the question that came up with all of our clients is, if you had stock options, should you not use them anymore because of this change, or should you reduce the emphasis on them? So on the bottom of the chart there, you see the TSX prevalence of each vehicle and then the average mix. So how many companies have these vehicles? You can see 93% of companies, or the S&P TSX, have performance share units. So virtually everyone has one. 52% have restricted share units, and 64% still have stock options. That's actually quite a high number, and we haven't seen it change dramatically year over year, actually, based on this tax change. And in terms of the mix, you can see performance share units in the middle has 56% weight out of 100% of an LTIP grant. And the reason for that is because institutional investors and ISS and Glass Lewis and others that many of you are aware of do have an opinion on this, as well as other institutional investors. Their opinion is that unless you have a performance parameter other than share price, it is not considered a performance vehicle. So in order to be considered a true performance vehicle in the eyes of some of these governance bodies, you need to have performance share units, and optimally you need to have it at 50% of the units. So that's de facto why we end up with these big reputable companies defaulting to at least 50% weight on performance share units, is due to those external pressures. Followed by stock options, actually 25% weight on average at the stock options, and then the rest is sort of filled in with restricted share units on the LTIP weights to add that balanced approach to retention, because a restricted share unit, frankly, is always worth something to the participant over the period of time. Way less risk in those.
And so Amanda, just in terms of, so that's interesting in terms of sort of, I guess, current state and where we currently sort of see companies providing LTI, but as we look forward and given some of the stock option tax changes, et cetera, what do you anticipate in terms of future trends around LTI?
Well, I think we would continue to say that stock options are a good vehicle. And the main reason why we think stock options continue to be a pretty good vehicle to at least be part of the portfolio of equity incentives is because of that longer horizon. If everyone goes only to performance and restricted share units, we're no longer really talking long-term because we keep talking about 3-year horizons. So I do think that there is interest in continuing with that. There is a little caveat because, you know, the very interesting part of where this can go is that equity reserves, which predominantly are stock options, most Canadian companies actually settle restricted share units and performance share units in cash. Just if you have an equity reserve, you actually can have the restricted share units and the performance share units vest beyond 3 years. The 3 years is actually a Canadian tax salary deferral arrangement rule, it's called. And if you go beyond 3 years and you're settling in cash, you're creating a tax problem for the participant. Revenue Canada wants their tax on a cash vehicle within 3 years. If you go to an equity approach, you're able to go longer. So I think where we're heading and where we're seeing is some conversion of stock options to allow the flexibility of equity settled restricted share units and performance share units. That's sort of where we hope anyway it goes, because it just gives that much more flexibility to do the right thing in the long-term incentive plan.
And in terms of the performance share units, you talk about performance vesting. And so we're just curious in terms of what type of measures, when we say performance, what are companies typically using?
Sure. So for publicly traded companies, the predominant metric is as relative TSR, total shareholder return. Again, because the governance gurus issue opinions on this, they do prefer to have some relative accountability of performance over time. And the default of that with many organizations, partly because it's easier and everyone's looking at it, is to, again, have a performance peer group of organizations that your TSR over the 3 years needs to meet or beat those peers in order to get more than the 1x multiplier in the performance unit. So relative TSR is the predominant one. There are other organizations, there are many organizations starting to diversify from that again, adding an operating measure, adding a financial measure that they're able to measure over 3 years that is important to the organization. They're often, in those cases, just absolute. If you can set a target for 3 years and hold yourself accountable, maybe it should be in there. And finally, I'd say very more recently, energy organizations are starting to add ESG measures to the PSU plan at a minor weight, and more to come on that, but definitely evolving there.
And I see we have a question just came in through the chat. So given the long-term vesting period on stock options, what is the trend on keeping granted stock options if the individual leaves the company? I mean, I think I've seen sort of the greater use of clear sort of retirement definitions, or so much of a good leaver provision, right? So if you're leaving the company on good terms, either at a certain age with a certain amount of service, you've given sufficient notice to sort of facilitate an orderly transition. In many cases, you get to keep those stock options. Increasingly, you'll see preferential treatment for those retirement options where they can continue to vest through retirement, and then you have a period of time post-retirement where you can still exercise those options. So you are seeing that. Obviously, if you're going to just resign or you're terminated, there's more restrictive treatment. But I do think there is that concept. We've seen a number of companies look to provide a bit more preferential treatment if you leave under good terms.
Yeah, but I think it's rare that, unless it's a retirement situation, to have the entire term allowable. It's more like a 1 year, a 3 year horizon post leaving, even if it's a good leaver scenario.
Yeah.
So you're right, because they hang out there too long if everyone gets to keep them 10 years.
Good question. Thank you. I know Amanda's talked a little bit about ESG as we've gone through. This is, again, some research of Canadian companies, the TSX composite in terms of the specific use of ESG related measures within their incentive plans. So we find overall close to 60% of companies have ESG measures within their incentive plans. One thing to keep in mind is, ESG is a very broad concept. It incorporates a number of different facets. It's commonly defined to include things like employee health and safety, customer service, environmental compliance, which are all measures that have been in plans, particularly in sort of mining and oil and gas companies have had employee health and safety in their plans for a long time. And so it's not surprising that, we come up with 60% of companies with some type of ESG measure. I think the interesting part as we look forward will be some of the newer measures, which aren't necessarily as common yet. So things around employee diversity and inclusion, employee engagement, a greater focus on the E or the environment and specific measures around carbon reduction are the ones that we're going to see, and we're starting to see increased use of within incentive plans. If we look at the type of inclusion, this refers to how do we include it within an incentive plan. And most companies in Canada, and this is actually quite a bit different than what we would see in the US, have incorporated ESG as a standalone metric. So it's an individual metric, it has a specific weighting attached to it, and specific targets associated with it. So it can be quite meaningful versus other companies that either embed it as part of a broader strategy scorecard or include it within their individual goals, where it might not have as much of an emphasis or be as clear or transparent in terms of what's required to earn the award. You'll see as we go over further to the right, the ESG category, what type of measure most predominantly, again, social and NHC referring to human capital measures. Again, given a lot of companies are incorporating employee health and safety and increasingly inclusion and diversity or engagement, obviously that comes up as becoming highly prevalent. And then finally, on the right-hand side, in terms of the incentive plan type, you see most plans obviously have included them within their annual incentive plan, and 9% of companies have disclosed the use of ESG measures within their long-term incentive plan. And that's something that we anticipate will increase over time, because as you think about certain measures around carbon reduction, around diversity, these are long-term they're sort of extremely hyper long-term expectations for change that can't necessarily, you can't necessarily move the needle significantly in a one-year period. And so I think it's probably more reasonable to look at these issues over a 3-year period as an example and capture that better within the long-term incentive plans. And so just on this, I think the key questions around ESG, this is sort of a top priority for many Canadian organizations. I think it's one where we have to just remember we're all on a bit of a journey. You see a lot of sort of press and noise around the benefits of ESG. I think it really does depend on what your strategy is, what is material to your organization, how do you really prioritize what is most relevant to stakeholders, and what do you want to pay for? And so I think some of this will just take more time as companies refine their ESG strategies, get a better sense of the measures themselves, get a better sense of how do we actually measure performance. Can we measure our carbon footprint, and are we willing to pay for that? And do we have the right baseline so that we can set the right targets? And all of that, I think, will just take companies time. And we just have to keep remembering that the strategy needs to sort of drive this from a compensation perspective. We can follow on once we have the strategy, once we have a good sense of being able to measure performance, we can then start to incorporate it more robustly within our incentive plans.
Yeah, very topical.
Maybe shifting gears a little bit, Amanda.
Sure. Okay, so on the governance topics, we talk about these tools, governance tools within compensation design, as well as processes. And one of them is Say on Pay, as many of you are aware of. That continues to be Say on Pay in general in Canada has continued to be very well supported in Canadian companies, despite the fact it is voluntary. So 99% of the S&P TSX composite had a Say on Pay vote in 2021, and the average score was 92. So it's very high, it's very good. I do think it's a bit of a Canadian pride thing. If you compare these scores to the US, there's a little bit, it's mandatory in the US, but the acceptance rates are a little bit lower, and there's often, you know, a handful more US companies that sort of blow through the acceptance rate and fail say on pay. It's not very many companies in Canada that ever actually fail the vote. So it's because everyone does such a good job of describing their pay for performance relationships, clear disclosure, and frankly, you know, having good pay practices. In terms of other governance tools that we see regularly these days, of course, they're listed on the left there, is share ownership. So it's an interesting topic these days. It's been around for a long time, but the part that's interesting more often now is that there's being requests of management to hold real shares. Well, management and directors, in fact, rather than these phantom shares. So to see truly that there is alignment with shareholder experience. I think many executives don't like that comment because it is their wealth at risk, even though it's phantom. But practically speaking, you don't get a proxy mail to yourself if you don't own a real share. So there's quite a bit of pressure to have some level of real ownership. And so that's impacting a little bit the design to help employees or executives just get real equity through the vehicles, but also just mandating it. So as an example, there are organizations that are putting additional hurdles into their minimum share ownership guidelines. As an example, saying something like a third of this amount of share ownership guidelines needs to be held in real shares. So it allows the executive to purchase the shares when they can, or maybe hold them in their family trust or whatnot, but give them a little bit of flexibility as long as they have this 1/3 of the minimum ownership in real shares. So interesting debates around that. Other topics listed here have been around for a long time as well. So the clawbacks and anti-hedging have been around quite a while. It sort of comes from the US practices and policies by the SEC. We are doing it in a more kind touch in Canada, in that we don't have rules around this. It is the organizations that get to define their own clawback and anti-hedging policies, but they've been around for quite a while and not changing too much. Interestingly, the most recent, just last week, legislation or regulation, I guess it's called, coming out of the US is the SEC pay for performance disclosure requirements that are actually being enacted for all US companies. It's a new, quite a big exercise that if organizations hadn't been doing, say, pay for performance disclosure, there's some rigorous steps to follow. As an example, there needs to be a comparison to executive pay trend in executive pay, meaning direction up or down, as it aligns to your TSR or another financial measure and another financial measure. So that's coming to the US. If you're a foreign private issuer in Canada, it does not apply to you, but it's creating a lot of conversation and ripples around what is the right way to display our pay for performance relationship, even though it's not really related to Canadian companies unless you are a true US issuer. So that's interesting, sort of trending coming from a governance perspective, is increased conversations about displaying the pay for performance relationship that your organization has. And I guess our last point is this external robust disclosure, which is aligned to what I just went on and on about in terms of the pay for performance explanation in a clear, concise manner. It's become, the proxy disclosure for publicly traded companies has become less of a legal document and more of a communication document, but of a shareholder relations document in some cases. Of course, it ticks the boxes and is legal in the sense of compliance, but many organizations are using it as a tool to communicate the consistency of messages around ESG, about performance, about, you know, many things to prove this relationship between pay and performance.
Perfect. And so finally, just our last points to go through, and then I know we've got a couple of questions coming in, and so we'll turn our attention to those questions. If there are any more, feel free to send them through to us. And this one gets to Amanda alluded to it earlier in the discussion around the broadening HR committee responsibilities. So first and foremost, we're increasingly seeing human resource committees versus compensation committees. And really the idea behind that and taking a broader scope simply to the name is that there's additional people-related responsibilities that the board and then ultimately now the HR committee is responsible for. There was a recent ICD study that indicated that that went to directors and asked them, you know, what are some of your top concerns for your organization? and human capital was amongst at the top of the list. So clearly this is something that boards are wrestling with in terms of how do we, more effectively oversee our talent? How do we ensure we have a healthy culture? How do we address inclusion and diversity and employee well-being, particularly as a result of COVID? And so, now you're sitting there as an HR committee and you've got these expanded responsibilities, and what do you do with it? And so you start with the scope of the mandate itself. What is the role of the HR committee in terms of overseeing and monitoring management's progress on these issues? And so clarifying what that means within the mandate. It means, taking on additional work. Either you take more time as an HR committee, or you start to look at what you do currently and look to see how can we reprioritize, right? If these are becoming more and more important, are there other parts of our activities which are more compliance or less strategic, and can we sort of streamline or reprioritize where we spend our time? And then given some of these broader responsibilities, do we have the right skill sets amongst the board, the right breadth of experience, or do we also need to bring someone else in to ensure that we understand what's happening in the market, we understand what questions we need to ask of management to ensure that we have sort of fulsome strategies and we're performing fulfilling our responsibilities. And so what that also means is that, as you sort of think about this, a lot of these topics, we've kind of over time established parameters for reviewing and understanding executive compensation, pay for performance, and what you see there, I think, can be leveraged a little bit in terms of these broader HR responsibilities. So it's, being data oriented, really understanding your organization in terms of current baseline, in terms of current data, setting up ways to monitor and regular monitoring of the long-term trends and performance, understanding where you're positioned relative to others within your industry, and ensuring you're posing the right questions and you've got the right sort of level of information. I think a lot of us, as we've sort of started to see this, is that a lot of the descriptions, and HR hasn't necessarily been as data oriented as some other functions, and so a lot of it is very descriptive or subjective. And I think that's where you're starting to see change in terms of, it's not so much about let's talk about it. You're going to need to demonstrate that. Are we making meaningful progress around diversity? So not just ensuring we're doing all the right training or ensuring we're doing all the other things that are important, but are we actually getting the outcomes that we're looking for? And so I think there'll be more pressure on boards to be able to sort of demonstrate that they're performing their oversight responsibilities and that they are actually seeing outcomes. So when you're disclosing this to shareholders or other stakeholders, you're able to sort of say, yes, we are, we've taken an active role and we're actually seeing movement being made in these important areas.
Absolutely. Thanks, Ryan.
So with that, I know we had a couple of questions, and I think there was one here around peer group development, Amanda.
Yes, I see. The question is around how often do we see enterprise value being used to select peer groups for executive compensation, and you're right. The person who submitted this, in terms of it being a good indicator of complexity, and so I would say predominantly organizations plainly use market cap, but we would say there are lots of examples where enterprise value is more appropriate or appropriate to look at in addition to market cap. Of course, if your organization is heavily influenced by debt, as you all know, it's plus the debt portion, it's the market value plus the debt value of the value of your company. I think it's a good idea to add. We at Southlea use like a triangulation. We always use multiple indicators of size, scope, and complexity. We would never use just one, as well as areas of operation and market for talent, even performance. Sometimes we use in that you don't want to necessarily mimic the pay practices or pay levels of a dog company. You want high growth, high performing organizations to be included in your in your peer group. So definitely a good question.
Yeah, and then the other one was around, given how nebulous ESG is and how difficult is it to manage, could you get pushback from leaders if this was incorporated within their compensation? And I would agree. And I mean, I think that's where sometimes I think we've gotten a little ahead of ourselves, where companies have been so focused on responding to investor feedback that they, how do you incorporate ESG within your compensation programs, that they've jumped to incorporating it in their compensation programs without actually thinking about what are the right measures, or have we sort of gotten to a point where we're comfortable as a business as a management team in understanding what are the key parts of ESG? Do we understand our current baseline in terms of performance in those areas? Are we therefore then comfortable with having targets associated with where we're currently stated? And then at the end, are we then comfortable with incorporating it into our compensation programs? If you jump to, we need to incorporate it in our compensation programs, and we're not necessarily comfortable around the strategy or comfortable with the information used to measure performance, I think that's where you're going to run into troubles. And I think that's where organizations need to sort of be able to step back and sort of step into it on a more timely basis, starting with the strategy, starting with the right information before jumping too far ahead.
Yeah, and I would just add that it's interesting because when a board makes a decision about, no, yes, this is going to be in and going to be here in the programs, it magically does create a focus on, actually, we can measure this, and actually here are the key measures for us within our organization. Right. So it does help prioritize it. It's interesting to watch it in many organizations, like what actually happens. It is creating change. I'm like not totally sure we should be paying for some of these things. There are things that just need to be done, but it is at least creating the right focus and motivation for people, and will recognize people for doing the right thing in the end, which is great. And yes, the document will be shared with everybody. That was another question being asked.
Yeah.
So both, I think the recording and the PowerPoint are going to be posted to your site somewhere.
Perfect. And if there are any other questions as you sort of reflect upon the discussion or see the slides, our email addresses are here. So feel free to reach out to either one of us. And with that, I'll turn it back over to Claire.
Thank you very much, Amanda and Ryan, for that wonderful presentation. It's greatly appreciated.
Great, thank you.
Thank you. Good to be here.
So I'd like to thank everyone for joining us here today. And we will have upcoming webinars posted on the CGIC website that you can check out. And of course, this will be posted on if you'd like to watch it again. So until next time, I'd like to say goodbye, and we will see you.